Welcome to The Explainer. Today we are diving deep into a really crucial concept in capital gains, something every tax professional absolutely has to get their head around. We're talking about the deemed cost of acquisition, specifically under Section 73 of the new Income Tax Act, 2025. All right, let's kick things off with a very common situation. Imagine you inherit a house from your parents, or maybe you receive some shares as a gift. Now, down the line, you decide to sell them. The big question is, what's your cost when it's time to calculate the capital gains tax? I mean, you didn't pay anything for it, right? So is the cost just zero? Well, the law has a very specific answer for this, and it's designed to make sure that's not the case.
Okay, so here's how we're going to break it all down. We'll start with what deemed cost even means, then we'll get into the specifics of Section 73. After that, we'll look at some key scenarios where this applies, run through a practical example, and finally cover some really important compliance tips and common mistakes to avoid. Let's get into it. All right, first things first, let's really get to the heart of this idea, the deemed cost of acquisition.
You know, in most cases, the cost of acquisition is super straightforward, right? It's simply the price you paid to get the asset. That's your starting point. You take that cost, subtract it from your sale price, and boom, you've got your capital gain or loss. Pretty simple.
But what happens when you didn't actually pay for it? This is where the law gets clever. It introduces this concept of a deemed cost. The system basically says, okay, we're not going to just call the cost zero, because that would create some huge tax loopholes. Instead, we're going to deem a cost to make sure the calculation is fair. So, let's get into the nitty-gritty. We're now looking at the legal framework itself, Section 73. Think of this as the official rule book for deemed cost.
Now, for all you seasoned professionals out there who are familiar with the old Income Tax Act of 1961, this concept is going to sound very familiar. What we're seeing in Section 73 of the new 2025 Act is essentially carrying forward the same core principle that we had in Section 49. So the good news is there's continuity here. It's a smooth transition, which means all the established legal thinking on this remains consistent.
And here's the absolute heart of Section 73. The law says that your cost of acquisition, well, it's deemed to be the cost that the previous owner paid for it. This is so important. It's not the market value on the day you got it. The idea is that you literally step into the shoes of the person who gave you the asset. Their cost becomes your cost.
Okay, that's the principle. Now let's look at some of the most common ways people acquire assets where Section 73 kicks in. You'll see how this step into the shoes logic is applied across the board.
You can really see the pattern here. Whether you get an asset through a gift or a will, or through succession or inheritance, or even in more complex situations like a company liquidation or a transfer to a trust, the answer is always the same. The deemed cost is the cost to the previous owner. The law is super consistent on this point. We always look back to the last person who actually paid money for it.
All right, theory is great, but let's make this real. It's time to crunch some numbers and see exactly how this works in a practical calculation.
So, let's meet Rohan. In 2028, he sells a house for 1.5 crore rupees. Now, this isn't a house he bought. He actually inherited it from his father back in 2026. This is our case study. Okay, here are the key figures we'll be working with. So, his father bought the house way back in 2005-2006 for 20 lakhs. Rohan inherited it in 2026 and sold it in 2028 for 1.5 crores. Now, we also need the Cost Inflation Index, or the CII, for those years. Remember, the CII is what helps us adjust the original purchase price for inflation, so we're only taxed on the real growth in value. So let's break down the calculation, step by step. First, what's Rohan's cost? Well, according to Section 73, it's his father's cost, 20 lakh rupees. Simple. Second, and this is super important, the period of holding also includes the time his father held the property. Since his father bought it back in 2005, this is definitely a long-term capital asset. Third, we compute the index cost. We take that original 20 lakhs and adjust it for inflation using the CII, which brings the cost up to about 66.67 lakhs. And finally, we calculate the capital gain. Take the sales price of 1.5 crores, subtract the index cost, and we get a taxable capital gain of 83.33 lakhs. See how that works? Okay, understanding the math is one thing, but complying with the law and avoiding some really common traps, that's a whole other ballgame. Let's get into some practical advice. When it comes to compliance, documentation is everything. It's absolutely non-negotiable. You have to preserve the original purchase deed of the previous owner. Also, keep records of any major improvements they made, because that can be added to the cost.
And of course, you need the will or gift deed. Now, what if you just can't find that old paperwork? Well, Section 73 subsection 11 gives you an out. You can get a valuation report for the date the previous owner acquired it.
All right, let's talk about the common mistakes we see all the time. Please avoid these. A big one is just taking the cost as zero or using the market value on the date you inherited the asset. That's just wrong. Another classic error is forgetting to tack on the previous owner's holding period. Get that wrong, and you might accidentally classify a long-term gain as short-term, which means a way bigger tax bill. Also, make sure you use the right CII year. It's the year the previous owner bought it, not the year you got it.
Okay, we've gone through a lot. Let's boil it all down to the absolute key takeaways you need to remember.
So, to wrap it all up, first, even if you didn't buy an asset, the law gives you a deemed cost, so you're not starting at zero. Second, to find that cost, you always have to look to the past. It's the price the previous owner paid. Third, remember that time travels too. Their holding period becomes part of your holding period. Fourth, this isn't a brand new idea. It's just a continuation of the old Section 49. And finally, and I can't say this enough, documentation is king. Your whole case depends on being able to prove that original cost.
We really hope this explainer helped clear things up on the whole idea of deemed cost of acquisition. Thanks so much for watching, and if you found this helpful, please do like, subscribe, and share.
And just before we sign off, please take a quick look at our standard disclaimer.